You can only have so many one-offs until it's clearly a trend. We've seen that in tech. We've seen that in parts of finance. It is interesting that it's starting to hit some of these less interest rate sensitive areas. In some cases, they did, just accumulate extra labor compared to what they needed, especially, when labor is scarce, you kind of hire first and figure it out later. So I think there's some of that normalization, and some companies will be more affected than others. But I do think we're starting to see kind of a broader deceleration. And like I said, it won't necessarily impact every industry, and it certainly won't impact them all equally. But I do think it is the things tend to spread because, for example, those laid off tech people, they will travel less. They'll go out to restaurants less. There may be not directly impacting something like McDonald's. That's a broader story. But basically, when you see people lay off in one sector, even if other sectors are not the epicenter of it, even if they're not being hit as hard, they're still impacted by other people losing their jobs.
Just more of an out of left field thought, perhaps, and feel free to challenge me, but perhaps.
So I think that certainly labor pressures, higher wages, incentivize more automation. I think that's been really clear in the grocery store market, where you see fewer and fewer, human cashiers and more of those automated checkout areas. We're seeing that, hit fast food restaurants more as well. That's not a surprise. The McDonald's case, I mean, they still need people in the back, until robotics gets advanced enough that you don't even need, people cooking. But certainly ordering and things like that can trim certain types of labor and make that more efficient. So I do think that automation and AI is, it's already been a multi-decade trend. I mean, you can go back to the 2000s and the 1990s, and automation was already there in certain sectors. As it gets better and better, it can displace more types of jobs. I think that some of the recent advancements in AI we've seen can replace some types of, say, repetitive white-collar jobs. Especially, give it a few years as it, sorts things out, gets more efficient, more accurate. I do think those are disinflationary kind of anti-labor technologies that take out certain efficiencies in the market, but then hopefully they create other opportunities elsewhere.
Just a disclaimer: none of this conversation.
So I think that's partially going to be a policymaker decision. Depends how much they want to fight inflation versus keep the economy somewhat on track. So predicting that is partially predicting what Jerome Powell is going to do, what Congress is going to do, whether they might jump in with fiscal support or not, and what timing around that. So I'll be the first to say that I don't know the answer to that. If we look back at a number of recessions, I think the dot-com recession is instructive here, because there were similarities with these types of assets that were very euphoric, right? The tech sector, especially the unprofitable tech sector, that was clearly a bubble both that time and this time. What made that recession interesting is it was actually a very mild recession by most indicators. So the 2001, 2002, 2003 period was very soft economically, but you had generally less unemployment than recessions that came before it and recessions that came after it. It was one of the more mild ones. So I think it's certainly possible that this could be along those lines, where it's not the gigantic recession that we've been accustomed to in the past, the global financial crisis and the COVID shutdowns. But I mean, there are certainly policymaker choices that could exacerbate it. I mean, if they mismanage how they run the money, because we have a very centrally managed money system, you can certainly cascade into more and more losses. And it's also going to depend on how quickly things like AI can ramp up. But generally, I'm looking less at one of those big deflationary collapse type of recessions, and I'm looking more at a stagflationary type of recession. But we'll as data comes in and as policymaker decisions come in, we can get more clarity on maybe how severe this might turn out. Right now, in the next several months, we've been in a disinflationary cycle. I think we're going to continue to be in a disinflationary cycle. Now, in the 70s, for example, you would have inflation come down from a high level to a level that is still pretty high. Inflation breakout during recession, because their currency works differently, right? Because they have liabilities that they can't print, and therefore they tend to experience different types of recessions. One thing that makes this period interesting is that there are tighter energy constraints now. And so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where, you know, on the demand side, you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They could still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. So, again, giving an exact number is partially depending on human policymakers, but the way I would phrase it is that the constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removes some money that was printed, but only a small portion of it. Most of the money that was printed is still out there. We still have not had really a capex cycle in energy or commodities. We've not brought new copper mines online at scale. We've not brought new oil fields online at scale. We're seeing some obviously development around LNG export capacity to, for example, reduce Europe's reliance on, now that they've been severed from Russia, they need more LNG. So obviously there's work being done, but I think the world is still relatively tight on the supply side. And so if you see China really ramp up and fully reopen in terms of international flights and things like that, and if you see, just general more economic activity throughout the world, you could certainly have an environment where oil is back over $100, for example, while you have economic softness. I mean, if you look at 2008, for example, oil was spiking kind of at the early stages of that recession. It was actually in some ways contributing to that recession. And so the timing doesn't always work out the way we expect. So the way I look at it is that if we're willing to go into a recession, we can certainly get inflation down for periods of time. And the question is, when we try to accelerate out of that recession, when we try to have another growth cycle, I think the problem is that inflation, the conditions are still there to reignite another inflation wave. So inflation came in waves in the 70s, it came in waves in the 40s, and I think it's going to come in waves in the 2020s. Even if I wouldn't try to predict the exact lows and the highs, I'm more trying to, look at the conditions and expect the direction. Sure. So I noticed a number of people posting these kind of doom charts about the Fed, and the remittances to the Treasury went deeply negative. And one of the problems is that the St. Louis Fed's charting tool, which people were referring to, was kind of broken for this particular metric. So I wanted to dig into it, make my own charts from the data, and explore what was really going on. And so, I published this article, and when people think of banks, the funny thing is that central banks actually work pretty similarly. They just have a few extremely important differences. So a normal commercial bank, you have assets and liabilities. And in an ideal scenario, the assets are higher yielding than the liabilities, so that the bank is earning a spread, right? So for example, deposits are lower yielding than mortgage loans in most cases. And so the bank is able to make a spread. A central bank works very similarly. So, they one is all physical currency is a direct liability of that country's central bank in the current era. There were periods of time like in free bank history where banknotes would be issued by a specific commercial bank, but in the modern era, most banknotes are issued by central banks. So, dollars are liabilities of the Fed. Also, banks store their cash at the Fed, and they earn interest on it. So that those are bank reserves. And then there's also reverse repos, which is a little bit more complicated. But the point is they're also a liability of the Fed, and they pay interest. So the Fed has these liability sides, and then their asset sides is mainly longer duration assets. So they own treasuries and mortgage-backed securities, and those make up the majority of Fed assets. And for many, many decades, far longer than both of our lifetimes, the Fed's asset side pay a higher average yield than their liability side because banknotes pay zero, bank reserves historically didn't pay much, whereas the Fed's holding of treasuries and more recently mortgage-backed securities, pay a positive yield, and so the Fed operates at a profit, and that's partially what gives it independence. It's not given funding like a government agency like NASA, for example. It has its own funding source, and in fact, it by law it has to give its excess profits to the Treasury. So it's actually been a profit source for the federal government, and many central banks around the world kind of work similarly. And what made this cycle different is that because they raised interest rates so sharply from the zero bound, for the first time in modern history, the Fed's liabilities are higher yielding than their assets. So, what they pay on reserves and what they pay on reverse repos is, they're paying out more interest than they're getting on their very low yielding treasuries and mortgage-backed securities. So they're operating at a loss. They're no longer paying money to the treasury, and I think moreover, it shows what other banks would look like if they were to raise their deposit rates to the level we see in money markets and T-bills. If you were to see banks around the country raise their interest rates to 3, 4, 5%, many of them would have a similar operating loss and start eating into their capital like the Federal Reserve has. The main difference between the Fed and a commercial bank is that nobody can do a direct run on the Federal Reserve. So they're not prone to the same types of things that Silicon Valley Bank was. But the funny thing is the Federal Reserve has about $1 trillion worth of unrealized losses while operating at a loss. So it's actually if it were a bank, it would be bankrupt. But because of just its own operating thing, it's still able to operate, and it just kind of shows the crazy times that we're in.